The session is entitled Investing and Finance in Controlled Environment Agriculture. Our moderator today is Noah Hyams, founder of VEGPRENEUR. Next to him is my friend Penny McBride. Yes, you are next to him, aren't you? Founder, owner of Penny McBride Consulting. Andrew Grimmer, Chief Operating Officer of CropOne. And on the far, oh, Andrew's over there, I'm sorry. Boy, am I losing it. Next to Penny is Andrew Howell. There's two Andrews here, that's why. And Andrew Howell, boy, is the Vice President of Sustainable Food and Agriculture at Ceres Partners. And now we have the other Andrew, which is Andrew Grimmer, Chief Operating Officer of CropOne. We're so pleased you guys are here today. Have a great time. Thank you all very much.
Thank you so much, Jim. It's so great to be here today with you. Thank you, Indoor AgCon. It's been an incredible opportunity, and I'm so excited to moderate this panel on investing in the space. As Jim said, my name is Noah Hyams. I run VEGPRENEUR. We're a growing global community of entrepreneurs and investors building plant-based businesses. That's what y'all are doing, so I'm really excited to talk about how we can get more money into the space. So instead of me reading down your bios, which are all very impressive, I'm going to just let each of you, and I'm glad both Andrews are sitting next to each other, kind of talk about your experience in this space and what you're working on. So Penny, why don't you start?
I'm Penny McBride. I was reflecting on my time in Indoor Ag, and I was thinking that I came to the first Indoor Ag back in 2013. And I really was introduced to my journey into indoor farming when I co-founded Vertical Harvest, which is based in Jackson Hole, Wyoming. After leaving Vertical Harvest, I started my own consulting firm, and I've been really fortunate in working with some just really interesting and innovative, tenacious startups and people looking to expand their business and people wanting to invest in the space. I'm working on a couple of collaborative partnerships right now to look at starting some innovation centers, and so it's been a really, really fun journey for me.
Thanks. And I'm Andrew Howell. I work for Ceres Partners. We're a food and agriculture investment firm. Kind of two strategies in the firm. We have a very large farmland investment fund. It's about 180,000 acres, so we're sort of anchored in agriculture. And then separately, as help run our private investment vehicle, which is typically kind of growth equity. And we've been interested in the CEA space for over 6 years. I started coming to Indoor AgCon in 2016 and didn't know anybody or anything, and it's a very cool experience to be up on the stage here now. We've made 3 investments in the space so far, which is Green Farms, which is a large-scale leafy greens producer in the Midwest. UNU, great AI machine vision camera company, and also Tortuga AgTech, who's actually speaking on one of the other panels right now, robotics harvesting strawberries. So continue to be active in the space and certainly believers in the long haul here.
All right. Andrew Grimmer, I'm from CropOne Holdings. I've been here for about 2.5 years, and I think in that time frame, this is my 5th title. So, as a startup, you kind of have to be used to wearing a lot of hats. I'm currently a COO, looking over our expansion strategies, both domestic and international. One of our biggest projects right now, as some of you might know, is our joint venture with Emirates Flight Catering. So building a large-scale farm out there in Dubai currently, and then working on some interesting domestic projects as well.
So let's get right to the big questions here. There's a lot of money flowing into the space, and expectations can sometimes be unreasonable. Investors may not be familiar with the space, coming in and maybe expecting returns that they could expect in other industries, but not in this one. Maybe each one of you or whoever wants to answer this question can talk a little bit about the differences between like AgTech and like CEA and how investors should sort of approach their returns in this industry. So Penny, we can start with you if you'd like.
Yeah, I mean, I think it's important to understand what stage businesses are in their development. If they're early stage, if they've gone through an R&D phase, if they need an R&D phase, if they're developing their own technology for their growing systems, or if they're using other people's technologies, and how well they've integrated it into their overall business plan, and then really touching on a little bit of what Andrew said with CropOne. I think how mature are they in their business structure, right? As you were alluding to, you have to wear a lot of hats, but are people within the company wearing the right hats that are appropriate for also understanding, I mean, there are so many things to look at. What are their long-term growth plans, and do they have a clear path forward? And you know, what kind of roadblocks and pain points are they facing now, and really are they assessing what might be coming down the road in the future?
Yeah, I would say that, you know, we're at an interesting time with the amount of dollars that have been flowing in the industry. I think, you know, the word I would preach to investors who are already invested or are thinking about it is patience. You know, these are companies, especially as it pertains to actual operators, whether it's vine crop, leafy greens, strawberries. We're talking about very asset-intensive businesses in a supply chain constrained environment. That doesn't matter how much money you might throw at a problem, doesn't mean you're going to get your greenhouse or your vertical farm built any faster or more on budget. And so when you're looking at things that take 12 months to 18 months to build, you know, it's hard to apply the typical venture capital model to that. And I think to expect those same level of venture capital returns as quickly is really difficult. Now, technology and software is a separate thing, and I think there's been, from my experience and as an investor sort of actively in the space for a while, there's been a bit of a divergence that has happened, and companies want to be valued as technology businesses, but in reality, as it pertains to a lot of the kind of companies here in producing good quality food, they're actually sophisticated manufacturing businesses. And I think those carry different valuation expectations and frankly different return expectations. And so I think people need to be honest about the type of businesses that they're investing in and what they're looking at. And it is great to utilize technology to increase throughput and reduce your environmental waste and become more sustainable. But at the end of the day, you've got to sell a lot of lettuce or a lot of strawberries, a lot of tomatoes to return, you know, multi-billions of dollars back to investors. And so I think everyone has to be patient and be in this for the long haul, because I think most people in this room would agree, you know, this industry is going to continue to grow and continue to chip away at sort of the broader market. And so we've got to be careful. There are absolutely ag tech companies that are software technology enabled that can sort of deliver those returns. And large producers absolutely can return capital, but we've got to be realistic about, you know, what they're growing. They are manufacturing businesses of widgets. It happens to be lettuce or strawberries or anything like that. And that's what we've largely observed is there's a lot of really good innovation happening right now. And I think we all have to be sort of sensible in sort of how we enter the market and how we frankly expect to exit.
Yeah, I like that. Developing the future of food should take some time, right? And I think there's also this onus of responsibility on the company as well to understand what realistic expectations are, to couple realism with their ambitions. And it can be really tempting to maybe take the first offer that comes to the table from an investor. But that might not be the best strategy long term. That can end up getting into trouble if you can't maintain those levels of expectations that will soon follow. I think there also needs to be a more holistic view of ag tech and CEA. I don't think you can really look at just one, right? You have to know, whether it's CEA or ag tech, you have to know how well it will integrate with the other, right? It's two sides of the same coin. You know, if you're focused on growing, how well can you deploy and integrate the technology that's available? You know, one thing that we really focus at CropOne is, it does kind of sound a bit cheesy, but it's called plants first mentality, right? So basically what it boils down to is that we don't do anything. We don't introduce any sort of technology, any level of automation, any levels of systems or nutrients even, if it jeopardizes the quality or the yield of the plant, right? So it's understanding really what your core competency is and how you can use, whether it be technology or systems, to enhance what you're already doing.
One other thing that I could add, if you take a step back and look at any of these companies that are producing really good quality food, they're incredibly complex, and I view them as three separate businesses, which is a development company that is building and delivering greenhouses or vertical farms. In and of itself is incredibly challenging. Then you have to grow the plant, whatever it happens to be, and get the best possible yield, because that's where your unit economics really shine through. And then once you go through those two stages, you still have to sell the product, which is kind of largely under-focused on, I think, when new companies come to market. And that part is really difficult. All of them are areas in which you can fail, and getting all three of them right is incredibly difficult. And there's a lot of people who are doing that right now, but understanding the complexities at each stage And having one person that can handle all those is incredibly difficult. So you have an incredibly strong team, and we're starting to see that now more in the industry, which is fantastic. But I think people have to be really realistic, because as someone who has created financial models and looked through them, everything looks perfect, and everyone's got a plan until they get punched in the face, right? So all of these things are really difficult. People just need to have their eyes wide open as they get into that.
Just to follow up, what kinds of returns should investors expect in this industry?
I mean, obviously, the answer is always depends on what you're looking at doing, right? I mean, if you're looking at a pure pledge sort of software play that can scale up really quickly, and there's a big difference between hitting send and it being in everyone's inbox versus spending a couple $100 million building new facilities. And so, I mean, I think the returns will be there, and they've already been there in some cases. You know, when we look at raising a new fund, we look at sort of a blended average, because we'll have 4, 5, 6 companies in a portfolio, and so, you know, we look to have, you know, north of 20%. And that's knowing that, you know, some will underperform, some will outperform. You know, it's incredibly specific to the business. But hopefully large, so that this room continues to get bigger as the years go on.
So how do new investors in the space get educated? What are the different ways, besides coming in or Icon, of course? Penny first.
Yeah, I mean, I think it's challenging because, you know, on the surface, it's all very exciting. And so, it's so innovative and different from field farming, and we all want it to be the answer to so many of the problems that we have right now with the environmental challenges that we're facing. I think, you know, when it comes down to it, you need to look at the company health, and I think one of the most important things is to really step into their operations and see how they're functioning and what their operational health is like, because it's probably not going to be the first thing that somebody talks about, because it's not always pretty, and it's not the best, it's not the easiest thing to look at and peel back, and especially if you're not really attuned to how an indoor farm operates, whether it be a greenhouse or a vertical farm. I think there's a lot to unpack. So I think spending a lot of time with the company itself, really peeling back all the layers is really important.
Yeah, I would second that. Unit economics is probably the most critical KPI that you could come up with. Then also, obviously, you need to do your research. You need to really understand who the company is. What is their competitive edge amongst the others, right? And not just that, not only what they do well, but how transparent are they with what they don't do well? And how do they supplement for that? What levels of technology are they bringing, you know, outside of their company, outside of their own doors to fill those gaps that are really there. So I think that you know, that competitive edge is really important. And boiling it down, how scalable is a company, right? At its core, yeah, they might have, there's an expression, farming by accountants. It might make sense on paper, might make sense on a spreadsheet, but how scalable are they? Because that's the other thing with this is their competitive edge will be scaled. So will the gaps, right? If you're not aware of those gaps, then they're going to be scaled. And I also think that it gets down to how scalable is the team, right? It's kind of an important factor that we may overlook with our resources. Is, do we have the right people to bring this to the next level, right? Are these people the right team to get to the next challenge and get through what we're doing? I think that's a critical factor that we probably overlook sometimes.
I would say now in a loosely post-COVID world, with a heavy asterisk, with not some other variant down the road, I would say get on an airplane. There is a really established CEA industry overseas in the Netherlands. There's a large CEA industry in Spain. It's very different, but go and get educated, you know, at the work that other people have done for many years. There is a couple thousand acres under glass in Canada as well. So, you know, there's a lot of really interesting companies that are popping up. And I can tell you as an investor, I've had to learn over the years that when I read somebody's pitch deck, I'd be like, well, this is incredible. How could they ever fail? Of course I would invest in this. But, you know, you really have to kind of do the dirty work and roll your sleeves up and understand, you know, what happens on paper versus what happens in the field. And there is a large market that already exists out there for this. And so I think the best investors that we've worked with have walked those miles and kind of been all over the world to see what works and what doesn't. So my advice advice would be don't look at the first kind of shiny object that comes across your desk, and that might be the right option in the end, but turn over every stone because there's a lot of really cool things going on and you need to kind of get the full picture before delving in.
So yesterday, founder Pat Powers spoke on this stage about the greatest unlock for the industry is government support, which hasn't really been there. And I'm curious your take on that, and also if you think that's going to be happening in the near future. Maybe we start with you, Andrew.
It's difficult. It's really difficult. It needs to happen, but it's really not. With some of the domestic projects that we have in our pipeline, it is even just qualifying for incentives. They're not available. You have to get really aggressive almost with your business plan to qualify for these things and understand what's out there. I just don't think there's enough emphasis on that right now.
Yeah, I think it's challenging, and some of it is regional. And so I think government support, yes, it definitely needs to step up to help CEA thrive. I feel like we as an industry need to really reach out to the people who can make a difference. And certainly there are folks who represent our industry who are sitting on some interesting USDA panels. I've had some great conversations earlier this year with the Ag Committee, because they are looking to understand CEA, but we're in line with so many other different interesting projects. I think the thing that is helping the industry is that, as everybody's experienced, climate change is real, and we all know that we need an answer, and that can't be too far away because everything is happening now. So hopefully, I guess the best hope is that the impacts that we're all feeling now can really influence some decisions quickly.
I think there's a long way to go in terms of government incentives and getting them more involved, and I think we as an industry need to push forward on that. I think there's a balance though between, these are farms ultimately, right? They're growing good quality crops just as Field is doing, and coming from a company that owns roughly 180,000 acres of farmland, there's plenty of government incentives up there for the traditional farmer. In order for this industry to actually stand on its own, it needs to survive outside of any government intervention. It's good to take, what is available and understand kind of what edge you might have, but I think it needs to be able to stand under its own merits while still kind of getting that assistance in the long run, and that's how it becomes, kind of a permanent fixture. So I think there's a long way to go, a lot of lobbying to do, and I think there's certainly on the energy side of things, there's a lot of things that the government can do because this is, ultimately a really sustainable avenue. But I think it is a fine line. We need to get there, but we shouldn't need to get there, frankly.
Obviously, we haven't displaced traditional farming, but where do you see a lot of white space? Like, where would you like to see more companies pop up, and where would you like to see more dollars going? Maybe we start with you, Penny.
I think there's a lot of great companies here that are looking at growing new crops. We all think that, certainly leafy greens and tomatoes have been great to display what's possible in the industry and really allow us to break into the market. There's a need for calories. So I'm excited to see different growing systems that are able to adapt to help with just higher caloric foods, a diversity of plants, and even systems that are growing fodder for livestock. Even I know there's a lot of controversy around livestock, but I think that people are really stepping up to the challenge, and it's just going to take a little more time.
I think standardization is one that really needs a lot of work, not just in our safety qualifications and our health qualifications, our quality, but also just how do we market ourselves, right? How do we combine and market ourselves consistently? And then consistency around general KPIs, right? There's no real industry standards that we can all kind of say, okay, this is this is the goal. This is the best, right? It feels like we're all kind of in different places right now.
I don't know if this counts as white space because this isn't like a really revolutionary theory, but I really like the value chain around CE right now. There's obviously a lot of producers that are, again, producing great quality products and getting a lot of headlines, but there has to be a ton of vendors that have to support that growth ultimately. And if you fast forward 5, 10, 20 years, and their market shares continue to grow, I think there has to be a lot of companies that support that, whether it be equipment providers or IPM suppliers, technology providers. I mean, even some of the more kind of older school kind of value chain businesses that are selling into this space. I mean, that's what sort of excites me today. It's just the idea of the rising tide raises all boats. So there'll be a lot of winners on the production side, but there'll be even I think more winners on the value chain side ultimately selling to them.
I would like to add too, I think I've heard a lot of conversations about the need for workforce education and training. And I know that some universities are really trying to put some training in place, but I can't emphasize enough that I think that that's something that really needs to happen. And I think just general consumer education too. I think that a lot of people don't know what controlled environment egg produces. So, and I'm not sure exactly what kind of clear marketing could happen, but I think that there's just a lot of general consumer misconception about what CEA is all about.
What are your thoughts on alternative sources of funding? For example, equity crowdfunding or other ways for entrepreneurs to get money, either government grants or... Do you have any thoughts on that?
I think it depends on what you're looking for, what you need. I think there's room at the table for about any source of money. It really just depends on what the expectations are with it. Crowdsourcing, yeah, I think that's a clever play in the right scenario. Grants, I'm always open to grants, right? They take a lot of work, but they're definitely worth it if you can get them.
Yeah, it's obviously highly specific, for the stage of the company. As you're starting out and don't want to take too much diluted capital from a larger institutional investor, if you can actually get crowdfunding and kind of tell your story and get people around you to believe in that, that's a really great cheap financing in the traditional term. I think the banking world has a little bit of a ways to go because they don't necessarily know how to treat a lot of these bigger builds yet, especially on the earlier stage. For the larger producers now that have somewhat more proven financials, that's a little more bankable. But if for someone who's starting out, it's really tough to get traditional bank financing, so you typically have to go more expensive routes, whether that's equipment financing, which is an option, as debt, a number of different ways. And then there's the equity world that has been fairly frothy recently. But I think there's a lot of avenues right now. There's project finance, but I think the toughest part is starting. Once you get one up and running, your options get a lot wider beyond it. So I encourage people to crowdsource and raise money from the typical kind of networks. You start angel networks, things like that, and then you kind of gradually move up the food chain as whatever the operation gets larger. But I do think that once the banks kind of click into this, it'll make it a little bit easier to start a lot of projects, because I've seen a lot that are very much in a chicken and the egg scenario where a bank wants to see that sales are guaranteed, but retailers don't guarantee sales depending on the crop. And so you have what might be a good quality project with a good team, but you have sort of this imbalance of you can't get the financing until you can have guaranteed offtake, and those don't really match up in this industry. And so as banks get more comfortable with the operating metrics around these, I think that will hopefully become easier. But it's starting is the hardest part.
And on the same vein, and slightly different, I think there are more accelerators out there, which are great for companies that are starting up, because accelerators are built to help them through the process. I mean, it's very competitive and you have to qualify, but it seems like a growing landscape. I mean, in your opinion, Noah, and what you've seen, do you have thoughts on early funding for startups and growing companies?
Yeah, it's a great question. I also agree it depends on where the company is in its life cycle, and also how it positions itself, if it's a B2B or a B2C play. If you already have a community, maybe you're growing a small farm and you want to expand, you have customers, an equity crowdfunding campaign would be great. We have some companies in our community who are doing that. But if it's more of a tech play or B2B, maybe part of it explains to the average consumer that might not be moved. I know USDA grants exist, but as you said, they need to fill out. So there's definitely different ways to get money. And I guess that gets me to my next question, which is, as you said, valuations are frothy, money's out there. In what other ways can investors help the companies that they're investing in?
I mean, I think oftentimes just assessing their business model, their growth model, it's like you said, Andrew, things look great on paper. But I think really having them articulate what they see as their path point and laying out a growth model that is realistic is probably what I see as how investors can really help companies.
Yeah, I think sort of dovetailing back to my previous point about like get on an airplane and figure this out and talk to everyone. I think to be an investor in some of these new businesses, sometimes the money from an equity firm can be somewhat of a commodity, and if you're a company that's in the right position, they can be selective in who they let in and who they don't. And so you even have to position yourself, and we've had to do this in cases where we might have the money to invest, but it only gets you so far, and so you have to sort of demonstrate either your industry knowledge or your ability to help them kind of post-close. And so being, I think, specializing in a sense, we do things certainly beyond CEA, but having some level of specialty in it will, I think, allow you in what can be a competitive situation to ultimately be selected as the investor, and then really help them beyond that, whether it be industry contacts or sales, hiring, all sorts of things that this is an industry of kind of whack-a-mole. Every single day there's something going wrong, and so the more you can step in and help the entrepreneurs, the better. And I think there's a balance between helping and helping too much. So it's a balance, and I think that's one way to differentiate is try to know as much about the industry as they do, if possible.
Yeah, and I would second that know as much about the industry and as much about the hurdles that need to be overcome. So very real example, CropOne, so we have customers in our hand, right? And basically it takes three things to build a farm, right? It takes money, it takes a building, and it takes customers, right? But it's like this circular dependency that Andrew was alluding to, that investors, they want to see that you have customers, right? They need that guarantee of sorts, an LOI of a 5-year contract or something. But customers, in order to sign them, they want to see you have a building. They want to see that you've established, you're on the ground somewhere. Then, in order to get the building, you need funding, you need money, right? And so it's this, everyone's kind of pointing the finger at each other, and it makes it really difficult to take that next step. We wish you could get them all, lined up at the table at the same time. Say, okay, everybody sign right now at the same time. It doesn't really work like that, though. So I think that level of understanding, not just where the company is in its growth, but also realistically what's needed to overcome these challenges.
Andrew, maybe you can talk a little bit about the companies that Ceres has supported and what you saw in them that encouraged you to get involved.
Yeah, I think it comes from a belief in the long run in the industry, right? I mean, I think a number of years ago, leafy greens were sort of the next frontier. There's a long way to go. It's still very much a nascent industry, and so we saw an opportunity to try and enter that market. Again, it's very difficult. Everyone's wants to be the winner on the store shelf, and I think there will ultimately be a number of them. But we've had a lot of fun, being investors in Pure Green Farms and kind of riding the roller coaster, kind of getting one of those up and running and getting in market. And it's been a fantastic experience, and I would encourage anyone who has the opportunity to stand in one of these really advanced greenhouses or vertical farms, and you do kind of feel like you're standing in the future, right? It is really cool to sit there and kind of look at what I call sort of a perpetual motion machine, as you constantly have gutters moving around, moving through, cutting machines and bagging, and you're like, wow, this really does feel like the future. So that, and it's a good feeling to know that you're producing a really good quality product, and that's the case, I really believe, for almost everyone in the industry. And when you hear feedback from consumers or whatever else, and I see it in a number of different markets. I live in the New England market, and there's a fervent love for Lily Farms. I see Tim back there. People absolutely love the product, and depending on where you are regionally, kind of in the country, people very much feel that way about kind of their local producer, and I think that freshness does really matter. And then some of the other investments we saw, with Unu, the kind of ubiquity that they can go into leafy greens, they can go into ornamentals, they can go into tomatoes, they can go into cannabis. And so from an investor standpoint, when you're going to make an investment, you've got to get a sense of how big is the addressable market for whatever this thing can do. And we really felt that in any one of those categories, they can make a really successful business. And so that got us really excited. And so that was happy to be a part of a couple rounds of their financing. And then lastly, we all know what an issue labor shortages are. And so robotics is a notoriously tricky business, and for every kind of 10 robotic startups that start, a few are ultimately successful. And we are not typically kind of tech investors to date. And I think the fact that it was more CEA than it was, I think it was because it was a more CEA focused investment than it was robotics investment for us. It was kind of we got over the hump, but we got really excited about sort of the accuracy in which they can pick, today, and so where that can go. And knowing that you can, and talking to strawberry growers, because their technology today is kind of focused on strawberry and table grape. The labor shortages are felt all across agriculture. We feel it even in our traditional farming business. And so being able to solve that need even a little bit, of anything, we've invested in 9 companies across multiple sectors. That's one where, today probably has the fewest issues with sales, right? It's not that if you build it, they will come. They're all waiting for it, and as soon as it's finished, I think we'll be scaling up pretty rapidly. So, those are things that ultimately get us excited, and there's a number of, other things in the value chain that I think are really exciting, and in the broader ag world too. But I think, that's just, we're one group with a small portfolio, but it's been exciting to be a part of, and getting sort of a hands dirty in any of these businesses, it's really kind of cool to be able to step back, and even in a situation like this, and these last 2 days have been sort of incredible in a post-COVID world, of being able to shake people's hands that I've seen on screen for 2 years, right? It's been a really fantastic experience to get your hands dirty with these companies and really learn the industry a lot better that way.
So I guess another question that I would have for you, Andrew, is do you think the formula of ESGs plus profitability equals scalability? Is that kind of your...
Yeah, as I think about our pitch deck when we go out, because we have to raise money from investors and then turn around and we sit on both sides of the table at various times, and one of the things that we think about is the idea that a lot of times people would think about impact investing, and you would have maybe concessionary returns, right? Like you maybe not going to return as much capital, but you're going to feel better about yourself at night. I mean, I think for a long time that was kind of the general gist of impact investing. But I think we're now at a point with the advance in technology that the things that are making these companies more sustainable are what making them more profitable, right? Whether it's a highly automated greenhouse where you have vast reductions in labor and water usage and chemical usage and shorter truck miles, right? All of those things are really good attributes that grow good quality product, but they're also less inputs and less area to drive the product, and longer shelf life and less food waste, right? So those are all things that drive the bottom line. Or in Unu, right? They can scan crops and help reduce waste, or help predict yield so that you can load balance your sales much better, so you don't ever have to throw out product, right? So there's sustainability across the path. We've made investments in aquaculture where that is sustainable farming of fish is incredibly important kind of to the broader world, because we can't get enough fish out of the ocean to feed everyone. So we really think we're at a point now, an intersection, where sustainability is going to make companies more profitable, and you can have smaller companies make really big impacts, as we're already seeing in the CEA space now.
So for my final question, I'd love everyone to maybe share something exciting that they're working on, if they can share. Penny, you have something going on, maybe you want to start?
Sure. I'm working on a kind of a plan, a feasibility study for an innovation center with UC Davis, UCANR, to build a innovation center focused on agriculture, food, and health. So it would be an actual physical space with varying types of lab space, greenhouse space, CEA, fermentation, biotechnology, and it's all at that intersection, really trying to attract people, entrepreneurs, existing companies looking to scale at that intersection of agriculture, food, and health. So it's really that sweet spot that I think the industry and consumers are asking for growth in, because I think we've all seen a lot of great, and rightly so, excitement about alternative proteins, alternative food sources that are more efficient and less resource intensive. But I don't think that a lot of those products always look at the health aspect. So for me, it's really exciting because I've been able to learn about companies that are using plant-based products to really improve and add more value to what they're doing.
Okay, here are all the companies that we're looking at currently. There's a number of things that we find interesting in the pipeline, and nothing imminent, and we'll kind of see how things develop. We're going to go out and raise another fund, so at some point we'll go down that path, and we'll be on the other end of the table again. But I think with this and the other industries that we work on, there's plenty of really interesting stuff coming down the pipe. So hopefully we'll be staying active.
It's going through my mind, okay, I can't talk about that, I can't talk about that, I can't talk about that. But product development is really, really fun right now. It's really exciting for us just to go beyond just the leafy greens and the herbs, but also kind of venturing into brand new industries, which is super, super exciting for us. And hopefully we'll have more news about soon.
Definitely have us on the edge of our seats now. Jim, is it time for questions yet?
Oh, it's questions, yes. Sorry.
Hey, question time. Who's got it? There we go. No private equity friend. Sorry about that. I was a little sleepy because it's the end of the day, for goodness sakes. Be a sleepy question. Comment on the following thesis that the biggest trouble with CAE and vertical farming is that there are too many players, they're too small, and they're too local, and that what large-scale investors are looking for are marquee clients where you can provide product to all stores, not just a few stores around a single facility. How are you going to get to the national network that'll move you away from tiny venture capital to kind of big boy private equity?
You got to be aggressive. I mean, really, that's what it comes down to. You have to know you're scalable, have confidence in your competitive advantage, and know who the target markets are. It really comes down to that. I think really targeting those key distributors is critical. It's just not being emphasized enough, I believe.
The race is on. You walk around these halls the last 2 days and you talk to people, and everyone's gearing up for the race. And I think when we have this conversation 5 years from now, 10 years from now, there will have been a lot of consolidation, because there's going to be organic growth and there's going to be M&A, because the idea of going to add another greenhouse to your existing portfolio, it's going to take 12 to 18 months, right? But you could maybe buy that one over there and it's in your portfolio tomorrow. So I think there's frankly going to be a mix of both, and with the amount of money flowing into space, I don't know how that doesn't happen. And so I think brands will merge, and you will probably at the end of the day have 5 or 10 brands throughout, maybe some are regional, some are national. And that's my guess on how this goes. Someone can show this video to me 5 years from now and show me how I was wrong. But today as we sit, I think that's probably the likely scenario.
Yeah, I think there is going to be a lot of consolidation in the market, but I do think that there is still room for smaller farmers that have a fair amount of production, because companies, even like Walmart, are still supporting local farms on varying levels. So I do think there's space for everybody.
Hey, Austin Manis from Harvest Returns. We are an equity crowdfunding company, and so appreciate the comments, like you said, Penny, about the smaller farms. We've invested in the 10,000 square foot vertical farm, the $50 million greenhouse, investments as small as $5,000, as high as 6 figures. So we got the spectrum there of folks that are investing. Scale is always the answer, but from your perspective as an investor, as you're seeking investments, what are you looking for in a project that you would invest in on specifically exits? So as you're trying to exit those deals, whether your first money or last money, which you've done, what are you identifying in your analysis as an exit you want to see?
I mean, you need to have an idea of, I think it's always important to start with the end in mind. And so I think you need to, your strategy of what you're building is going to somewhat limit or open your potential exits down the road. And the way we look at it as an investor is there are so many different form factors, be it vertical, greenhouse, waterbed, aeroponic, aquaponic. Like there are so many things that you can sort of get into the weeds on. What we try to standardize on and try to valuing one versus another is what really matters at the end of the day is what you're producing. So what does it cost you to build versus how many pounds can you produce for that? And then what does it cost you to operate versus how many other pounds you can produce to that? The other metrics, the yield per square foot and all that kind of stuff are helpful in certain cases, but are a little bit of a misnomer when I think you're really trying to figure that out. So unit economics is agriculture at the end of the day. This is about cost and yield. Who can produce the best yield at the lowest cost? That's who's frankly going to win out here in the end, and that's going to open up your exits. And that's where the industry is going to have to move to in order for it to be sustainable. And that is going to, if you're a small scale farmer, the exit might be to a local entrepreneur who wants to take it over and run his lifestyle business. If you're one of the really big players, it's probably an IPO, and then the options are all through the middle. And so I think whenever starting a company, whether it's in CEA or aquaculture or a tire company, whatever the case may be, you got to know where the end game is and work backwards.
We got another question here. Hey guys, Ricky Stevens from Agritecture. We work with a lot of entrepreneurs in any part of the planning phase of a commercial urban farm or controlled environment farm. And Andrew, you did a great job of describing this conundrum that we see all the time between scale customers, big customers, and being able to unlock that financing. I'm glad that Austin just spoke. We have started a partner network of financing providers that can help to unlock that. But I'm still curious because I think we too often, where we see that specifically, entrepreneurs run into that issue is they have a pilot facility or a small scale commercial facility. It's not large enough to get big name customers quite yet. They have a good product, but they're just not able to unlock that capital, and they might not necessarily always want to build $1 billion business, so venture capital might not be a great route for them. Just curious if you guys have seen, especially middle Andrew, if you've come across those types of operations and what advice you give them, what other financing vehicles are out there that you've seen that you would route them to.
Yeah, I was talking to somebody actually just sort of about that situation. I would encourage in those situations where they're not, going to gear up for the race, right? They're looking to build a lifestyle business and sell to the local retailers, and there's absolutely still huge opportunity for that. And I would encourage those people to reach out to the local angel network. In any large city, there is an angel network of successful entrepreneurs and maybe people who have been in the food industry and have sold a food company and are now just sort of making angel investments. I think there is definitely a market for whatever the form factor might be of selling 5,000 or 10,000 square feet of whatever the product might be to the local retailers, and getting investment from kind of that, because that local story and that fresh story is going to what the ultimate, I think, wins out. And so I think the local entrepreneurs within a 20-mile radius of where there are is probably the best bet for that, on top of crowdfunding, certainly.
Firms or high net worth individuals, and they might only look to a couple of those examples that are public about CPA companies. And so how does devaluing or SPACs that didn't go through or something like that, how does that ripple across the whole investment thesis?
Good question. I think SPACs are sort of a unique thing that have happened at a moment in time. Not to say whether they're good or bad, but there was that brief period. The traditional IPO process has still always existed and will be an exit for a lot of traditional venture capital, even outside of agriculture. And there's there's strategics that are buying. I think a lot of actually CEO businesses are a good sale to a family office who are going to look at this as a 20 or 30 year investment, and that's something we originally always thought about with different greenhouse investments, like who is the best kind of holder of this in the long haul. So the IPO is a great sort of well-worn path, but I think the family offices, and I've spoken to a number of them over the years who want to get into the space but want to see it mature a little more, and so they can come in, and actually we're also seeing now McBride Farms with the Cox family. I think that's a really good example of sort of one of the natural exits for some of the potentially bigger players, or even the medium player that can ultimately grow to a bigger one. Is long-term permanent patient capital. As I started my spiel here talking about patients, I think that's a really good market and a good exit for some of these firms.
Yeah, I am Tim Kinner from Little League Farms. I got you some coupons, thanks for that.
Thanks.
The question I have is going through basically we're a decent size CEA. When we go through the pitch decks and we look at sort of like what the market opportunities are and understanding where it is, the drive for huge market opportunities in terms of basically generating what your valuation is going to be and then bringing it back. I think that there's some, I don't know, investors have to play their game, bankers have to play their game, but in terms of what is the right sort of like spin that you have, it's like what you're doing is looking for a large valuation to get, a good return, but then also it's a little bit give and take. How fast can you grow? Because you do get pushed where they're like, okay, that's not fast enough. So what I want to say is like, how do you basically square the corner on that?
Maybe make a lot of money if I can make a good answer to that question, or you. But I think it's a balance, and certainly kind of picking the right investors that understand that this takes a long time, and there's a balance between growing too quickly and not enough. Like as I said, I keep joking about the race being on. There's a way to sort of get lapped here, right? If you were to stay in your local market and next year I'm going to add another phase, or the year after that, it's going to take a long time, and so there's a chance to kind of get lapped in that. But also, you can get too big too quickly, right? The WeWork example, for instance, if you were to just throw a couple $1 billion at this problem, and I talk about the 3 phases of this, sure, but you can go out and build, and maybe you can grow, but how are you going to sell however many millions of pounds you're going to produce on the other end? You got to build that market, and so you do. I'm kind of talking out of both sides of my mouth here. You got to grow quickly, but also methodically too. So you have to build the market. It doesn't matter if you can do the first 2 phases if you can't sell the end product. And so I think it's picking the right partners, sticking to your guns and doing what you believe. And some people are trying to grow really quickly, some are methodically, and then I don't think there's a right or wrong strategy. And then we'll sort of see how it all shakes out again. I think there'll be a lot of M&A in this market, but this is new, frankly. It's not like we can point to all the other successful examples of this. Like the people in this room, the people in this conference are the ones doing it, and that's really exciting. And so, there's a buzz that's gone on here that I'm very happy to be part of. I don't want to monopolize the question. Anyone else?
We have time for one more question.
Thanks. So this is Ryan again from Two Acres. So I'm an entrepreneur. Started out with a small 3-container farm project, pilot project. Went really good, so now we're raising a $12 million round to do vertical stack towers. One of the issues that I was trying to work through on financing is that the long wait time to get built significantly impacts the internal rate of return. And I came from the tech side, so that's people want to see something quick. Is there any finance mechanisms that you guys use to boost the internal rate of return while the money is in hold or being used for 18 months or 12 months?
I'm sure there is a more sophisticated financial wizard than myself that could answer that question. There are investment firms play games with their IRR, and the trick that I tell myself is you can't eat IRR, right? You can eat multiple on your investment. What really matters is I put in $1 and I got 4 back, right? The IRR is something that people put in pitch decks to help raise money. And so, it's just my own personal perspective. There's equipment financing that can sort of help float that. That's usually a higher rate. So there's not a clear answer to that. Part of it is the market is the market. Everyone is facing those longer construction times. And that's, I think it's something we all have to live with right now, unless you are somehow completely vertically integrated. And I think the greenhouse companies, greenhouse builders, right, that are out there that are vertically integrated are going to have an edge up because they're going to be less reliant on their sort of third parties to help deliver. But I don't know when it sort of right sizes. Obviously, the supply chain is affecting the entire world just beyond CEA. But part of it, it might just be a kind of fact of life right now.
All right, well, you know, you guys are awesome. This is absolutely our last panel. We're done. I'm a little sad. I don't know about you guys, but please give it up. And thank all of you again. We hope to see you at future indoor ag cons. Be safe, and again, thank you.